How's it going, guys? This is Forensic Forex with Deontay, and I'm back with another video. This is your daily update to crude oil. As we can see here today on Thursday, we got another large candle to the upside. We spoke about yesterday that price is still most likely going to be bullish, especially after giving us that down candle. Price continued to trend away from this down candle, and we expect the price to continue trending upwards, targeting what? Buy side liquidity above a swing high. And we got that target here. They liquidate the buy stops above that high. We even see price get back to that other expected level, that 20-day look back high. So if we were to zoom out just to see the context of it, we did this at the beginning of the month. So if you go back to the first episode of this daily tracking or the beginning of this month for US oil, you see how we drew out IPTA so that we can have certain levels to our foresight. And we can see it came to fruition. Price came up and took out that 20-day high. At this point, people may ask, oh, should I sell now? Is there going to be a reversal? Should I be looking for higher prices? Well, what I would say is continue to follow the trend until you see other things change. So if you see correlated or inversely correlated pairs doing completely opposite and breaking its code or showing you some type of SMT diversion on the higher time frame, and you also see the asset class that you're trading starting to consolidate in a high premium range, then you can start to suspect reversal. As of right now, I would still remain bullish. As you can see, we're almost done with January, and we're able to read the price action day by day and how we were able to articulate ourselves, right? And find a way to sit on the sidelines. And when we provided ourselves context to say, hey, we're not trading tomorrow because we still need more context. And then when the context arrived, then we said, okay, now we're buying. And that's what I provide here for the daily updates. So hopefully you find this insightful. And it's really nice to see things come to fruition, especially as a trader who's been doing it for a while. All in all, it just feels good when you know you got the bias right. I know the Bears are mad. It's okay. We all get it wrong at times because there's going to be plenty of times where I'm going into probably maybe February or March or July, some other month, and I'm calling it to go higher and it doesn't go higher. But the whole idea is to change your stance when you're wrong. Find the trend. I could have been bearish on oil, but then at some point in time, I would have had to tell myself, okay, I'm not bearish anymore. I need to be bullish. So sometimes you gotta admit defeat that you got it wrong, and the market is not giving you what you want it to do. We happen to be, on the side of being informed about how the market unfolds, and we were projecting higher prices. Other people were projecting lower prices, and that's okay. You just got to understand the signs of when the market is not going to favor your speculation. The simplest way is to look at the higher time frame. Most times when people are trying to read me or tell me the direction of a market, they're not looking at it from a daily or weekly or monthly perspective. They're looking at it from a 30-minute, an hour, a 15-minute perspective. Too many cycles occur on those lower time frames. You look at the daily, in the weekly, and the monthly, it's cut and dry. It's black and white. It's going to tell you whether or not I'm bullish or bearish. It takes a few steps and a few swing points to really start to focalize where the market's going to go. And notice I'm marking off a lot of the swing points here. My chart is pretty clear. It's really clean. There's no indicators on my chart. I'm just reading the swing points because that's how markets move. They're aiming to break swing points and they're aiming to make swing points. Look, notice all the swing points it's made. A swing point here, it made another swing point here, it made a swing point here, but rated it here, made another swing point while rating that one, made another swing point here, and it continues to trend. Same thing on the flip side for the buy side, right? It's making a swing point here. Let's take off the annotations. A swing point up here. Another swing point here. That swing high. That swing high. That swing high. This happens to be a lower swing high, but we can see price immediately comes up and breaks that swing high, so it shifts it back, being bullish. Another swing high, and then it looks to be possibly another swing high, so maybe price does pull back a little bit and gives a retracement back into this large candles range, or it leaves a fair value gap, right? It leaves a little space open, and then it trades higher. So all in all, I'm still bullish. The sentiment hasn't changed. But I wouldn't be surprised if we do end up running into some type of pullback from where we are, because sooner or later, price for the monthly candle is going to make its high, and then it most likely is going to fall off its high by, you know, a couple of days. Now, this could be the high of the month, right? And then price comes down and closes lower than the high. So that's what you will see normally on a monthly bullish candle. So if you just take any monthly candle that's going up, let's just take this one for instance. Notice as price comes up, it made the high of that month at whatever day it was, and then it fell off that high, and then it closed here. So that's something we can expect to happen in bullish months and vice versa, bearish months. To predict that can be difficult at times, but just having an overall census of where we were throughout the month and how we were able to get the ideal buying conditions and when to buy, those indicators of when to buy. I kept saying it time and time again. Keep trading simple. You don't have to overanalyze the market. The market structure is pretty simple. Are we breaking swing highs and are we creating higher swing lows? If that is so, we are bullish. If we are breaking swing lows and creating lower swing highs, then that we are bearish. And then you continue to follow that trend. And while being in this bullish trend, I kept trying to refocus everybody's attention to those down days. Those down days are a huge indication that the market makers are most likely preparing themselves to buy again. I look at these down days and a bullish trend as if a t-shirt or a pair of sneakers or whatever the case may be went on the clearance rack. It's cheap. I need to buy again. It's cheap. You should buy the next day. Now, of course, trying to speculate how far the market is going to range the next day can be difficult. Now, there are definitely ways to, you know, process that, whether that's with standard deviations of the Asian session range, flout, central bank dealers range. Those are things I don't utilize because I just don't see them as worthy enough to place in my model because I'm a swing trader. But you can see the simplicity to how I'm reading the price action. You got to start reading it from the daily, guys. Stop reading it from such a lower time frame. The 30-minute, the 15-minute, that's cool for the day trades. But when you are looking for the overall bias of the market, you need to start getting higher than the 4 hour. You need to start jumping into the daily, the weekly, and monthly. Yes, sometimes the 4 hour may pass, but I would prefer people to start off at the daily and start reading it day by day. And you'll start to notice these patterns that I'm showing to you as well. It's not that I'm a genius or I'm a rocket scientist. I'm your average dude that just happened to sit here and study the charts with no indicators. Peace.